Three Magnificent Seven stocks have recently hit all-time highs, and with the new administration focusing on lower taxes and deregulation soon to assume power in Washington, every investor wants to know how much more room do these stocks have left to run. Joining us now, Daniel Niles, Niles Investment Management founder and portfolio manager. Dan, it's good to see you here. With all the broadening talk, we did see tech lead gains last week, so the broadening sort of paused, if you will. But what do you think is going to happen next year? Are we going to continue to see the runs that we've been seeing?
Yeah, I think next year you're going to continue to see the broadening pattern. And if you look at it over a longer term basis, so if you look at the first half of this year, the S&P was up 14%. But that was really led by the Magnificent Seven stocks. The equal weighted S&P was up 4% during the first half of the year. Since June 30th, however, the S&P is up about 12, but the equal weighted S&P is also up about 12%. And the policies of the incoming administration, which is lower taxes, more deregulation, that should help a lot of the smaller mid-cap stocks and more stocks in the value space where the cost of money and regulation matters much more for them than a big behemoth where it really doesn't matter that much at all. And then the second part of it is I do think you're going to see a pause or a digestion phase in all this AI capex next year. And obviously a lot of the stocks that have powered the market this year are heavily focused on AI spend. And so if there is some slowdown in that, you could see a big issue in the tech space, and that could potentially affect the overall market as well.
You know, Dan, you mentioned Trump moving back into the White House, and what's interesting is how he thinks about big tech. I mean, last week when he announced his support for Gail Slater, Trump just went off on big tech, right? I mean, made a point of their stifling competition, they're running wild, and certainly J.D. Vance, no fan either. What they seem to be is more fans of little tech, for lack of a better way to put it. I'm just wondering, Dan, like as an investor, when you see those kind of headlines, how do you think about that? Do you think about that, or is it noise to you?
It's not noise because you always want to invest with tailwinds. And so if you know that the new administration is really more focused on helping the littler names, then that gives you a little bit of a tailwind if you go look at that. But from a bigger picture basis, Josh, I think it's more about the fact that you had a 60% increase from the biggest spenders, the Microsofts, Googles, Amazons, for AI capex this year, and next year you could see that number slow to 10 to 20%. And a lot of companies, especially in the semiconductor side, aren't necessarily thinking that's going to be the case. But if you're not ending up with big returns on all of that investment, and think Microsoft, right? Microsoft reported the June quarter, they guided below the street for the September quarter for revenues. Then when they reported the September quarter, Microsoft guided below the street for the December quarter in revenues. And this is despite the fact that they have a 50% economic interest in OpenAI, which arguably started this whole AI buzz, which is the launch of ChatGPT at the end of 2022. And so that's the bigger thing to worry about for big cap tech next year, is if you go through this digestion phase, much like you went through after the initial surge of spending in COVID, and then you saw what happened with a lot of these stocks in 2022, that again would argue for more broadening to some of these other smaller names that have sort of been left behind in this big AI surge for the mega cap tech names.
Dan, then what are the implications of what you're discussing for the likes of Nvidia, right? Are we going to continue to see that willingness to spend on their chips going into next year? And of course, that's not even to talk about a potential headwind of ratcheted up tensions with China. I mean, we just saw an example of that today with these reports that China is looking into antitrust concerns with the company.
It's a fantastic question. And this is the way I would think about it. And you saw this during COVID. When you don't have enough supply of chips to meet demand, all your customers come in and double and triple order. Then what happens is as soon as you can meet demand, those orders start to get canceled. And so with Nvidia, they've talked about the fact that for the next 6 months, they believe that demand is exceeding their supply or ability to make those chips. But what I would say to you is I feel strongly about this, that once they catch up, because you're not seeing these big upward revision in revenues for the likes of Microsoft, for example, but you're actually seeing downward revisions, you're going to see these companies come back by mid-year, these customers, and say, you know what, we're going to spend 20% more or 10 to 20% more on capex this year than the 60% increase we saw in 2024. And Nvidia, if you look at their revenue forecast by Wall Street, Nvidia doesn't put out forecasts a year out in advance, but Wall Street has Nvidia's revenues up 50% in 2025, falling over 100% increase this year and the year before. And so I find it, at least from what I'm seeing today, hard to believe that they're going to be able to get to those forecasts. So you may see a nice move up in the stock in the beginning of this year, and then a big fall off in the middle of the year. And by the way, don't forget, during COVID, revenues went from up 84% year over year at the beginning of 2021 to down 20% by the end of 2022, and the stock went down over 60% in that move from peak to trough. And so that's an example of what carnage you could see going forward.
Dan, always great to see you and have you on the show. Thanks so much for joining us. Appreciate it.
My pleasure.